This is Trepp Wire Week in Review for week ending June 24th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, markets rallied after President Biden announced an infrastructure agreement, and the CDC extended the eviction moratorium to July 31st. Investors also had a bunch of economic data to chew on. Existing home sales dropped for the fourth straight month to a one-year low as median home prices rose, as did mortgage rates. Initial jobless claims dipped slightly but were a miss against expectations. Durable goods orders climbed 2.3% in May, boosted by the transportation sector, and the final reading on the first quarter GDP was unchanged at 6.4%. The ouster of FHFA Director swiftly followed a Supreme Court decision that the organization was structured unconstitutionally. But what does it mean to lenders, borrowers, and investors?
You gave us a mouthful there, Martha. There's a lot going on, but it was an interesting week. There was a lot of screaming headlines, but not a lot that meant anything tangible for investors, right? On the interest rate front and the interest rate hike side of things, we saw a lot of screaming headlines, but not a lot of anything that really meant anything, right? If we go back to our last podcast, we talked about the Fed chair moving up his time horizon for when interest rate hikes would start, right? 2 in 2023, markets sold off. 2 days later on Friday, the St. Louis Fed chair Bullard said that we could see rate hikes in 2022. The markets really sold off after that. Interestingly, Bullard doesn't have a vote on the committee, but his words were enough to really rattle the markets. On Monday, a couple of people came out and said, with ties to the Fed, that said, oh, don't worry, it's still going to be slow and measured, and the markets rallied. None of this is tangible, right? It's hints, it's feints, it's head fakes, and it moves the market considerably, but it's not something that you could hang your hat on, right? Until the Fed tapers, it's all speculation. Until the Fed says it's time, it's all speculation, yet it moves the markets a lot. And you could make that same claim for other things, right? This infrastructure bill came out today. People felt good about that. Wasn't overly expensive, wasn't that $2.3 trillion number that the White House was looking for originally. So the cost was kind of modest. I use that word very loosely at $953 billion. But leaders in the House kind of came out right away and said, we're not sure that we're going to vote for this. So again, a real blaring headline, but still iffy whether that crosses the finish line. And you could say the same thing, and I'll let Joe weigh in on this in a moment, about Fannie and Freddie. Their stock prices absolutely collapsed after the Supreme Court ruling, which got a lot of people's attention. But what this means for the market, for the multifamily market, for owners, lenders, borrowers, really unclear, right? It's a lot of speculation, and it was great for the newspaper business, right? Great for the internet pundits, but not a lot of things that investors could chew on.
In our world, that's the only thing that matters, right? Clickbait, clicks, eyeballs, impressions. We got to do big headlines, even if it's all sizzle and no steak. I think there's maybe just a couple of things to mention about the FHFA news. Calabria was a Trump guy, and he was the head that just got ousted. And word on the street was that, one of his missions was to get Fannie and Freddie ready, leave conservatorship and go and, become private again. And that's why those equities had rallied. And that's what some of those investors were kind of banking on. Now that that's not the case, we don't know what the case is, I guess. It's speculation right now, but, we can safely assume that I don't think a guy like President Biden wants to privatize anything, especially not the housing market. So a couple of things I was thinking about, how does this affect borrowers, lenders, investors, investors in Fannie and Freddie equity that they got killed, but thinking just like investors in regular Fannie and Freddie securities, I don't see really any issues or changes here. I'd say lenders similar, although maybe the next point will affect the lenders as well. I do think that they are going to continue down the path of more and more affordable housing mandates and more green mandates if, the Biden administration has anything to say about it. So that's something to think about as a borrower in that market and as a lender. How much more paperwork are you going to have to do? How much more retrofitting are you going to have to do? Are you going to have to change the types of properties that you're looking at in order to get the type of financing you want because of these kind of prudential, regulation by financing vehicle as opposed to regulation by law?
Yeah, I think that you're spot on a couple of things there. With the existing administration, they were trying to get to the point where this was coming out of conservatorship, right? Became a private company again. They could open up the spigots back so that the money wasn't going back to the Treasury. A light hand, if you will, in terms of how heavily regulated it was. Now for the foreseeable future, absent a real shocking personality twist coming out of the White House, the money will still go to Treasury, probably a heavier hand in terms of where they want to steer the lending towards, and probably never a hint of privatization at all.
Yeah, I would say there's maybe one thing, and I might be totally wrong here, but I do think that, and this is a small kind of niche area of the market, but credit risk transfers were kind of on the rise for a couple of years before COVID and coming out of Fannie. And then Freddie was, I think they may have done a couple, or they were just like getting ready to do them. I can't remember exactly, but that's where, Fannie and Freddie, they hold the guarantee risk. They hold the kind of like the first loss position on, the entire single family mortgage market, right? And a lot of the multifamily mortgage market. And what they would do is they would pool a bunch of these kind of guarantees that they have and sell off the risk to reinsurance companies. I think that had kind of taken a pause during COVID. And I think Calabria had been kind of a little tough in terms of the capital requirements for those types of transactions, but those may be, coming back a little bit, if whoever takes charge is going to look at those differently.
As a taxpayer, I'm definitely on the side of that risk that people are taking be taken by investors, not by taxpayers, whether it's student loans or affordable housing or other things. I do believe that, that risk should be shared by investors, not being held kind of universally by taxpayers. But, there I steer mildly into the political realm, and that's probably as far as I'll go.
Well, Martha, you mentioned the home price number before. What was it? 23% or something year over year? What was the number?
Year over year,
24% year over year.
And existing home sales down for a couple of months. And I don't think existing home sales are down because there's a lack of demand. I think it's because there's a lack of supply, a crazy lack of supply. And, I was just thinking, Fannie and Freddie they have this mission to provide kind of sustainable financing to the housing market. Like, wouldn't it be, if I'm not really advocating for this because I'm not super into spending tons of money, but at the same time, maybe a way to kind of make life better for a lot of people here might be to start bringing in single family construction more and more into that fold. You know what I mean? Because it's the construction, and we are like millions and millions of homes short of what we should be at this point.
So Joe, I know you're on vacation this week. Let me ask a true question here. Did you spend more time reading about the Fannie Freddie conservatorship or the Britney Spears conservatorship?
Oh, you know what? That's a toss-up for me.
That I'd say I'm about 50-50 right now.
Yeah,
I
me
still
too.
have to watch or listen to Britney's, I guess, court speech, whatever you call it. I don't know if it was a deposition or something. I heard it was
yeah.
pretty powerful. I got to listen to that. I mean, Britney was a very huge icon in my kind of 8th, 9th, 10th grade area. And then it's kind of weird to look at her now. because you still picture her as like the oops, I did it again lady, you know?
Didn't you lobby to get that poster from your bedroom taken over to your new home? Wasn't that one of those things you try to slip into the prenup?
That was a good joke and definitely just a joke.
That and the wagon wheel table.
No one's
I was
gonna
more of a
want that
Don
wagon wheel
Mattingly
table.
poster and Mike Richter poster kind of guy. I guess in college, there were probably a few risque things on the wall, but I don't think there were any Britney, hit me baby one more time. No, none of that.
So, Joe,
Speaking of which.
yeah, exactly. You mentioned environmental policy, and we saw a green deal, the first to meet the ESG criteria. Is this a
It's funny.
one-off?
The
or-
ESG criteria? What the heck does that even mean? Yeah, there was a story in Commercial Mortgage Alert last week about One Vanderbilt, you know, the giant, I think it's SL Green building that they put up right next to Grand Central. Looks like they're going for a SASB financing, single asset, single borrower, CMBS financing, at least for part of the financing. And based on something, the way that the building is retrofitted, based on its HVAC systems, based on its efficiency and those types of things, there was a company out there owned by Morningstar that basically gave it its ESG stamp of approval. The issuers are selling it as a green, or I should say as an ESG CMBS deal. So, I mean, it's great that this building is, you know, having less of an effect on the environment than it might otherwise have, but it sounded like the market for it, or the demand for it, or the investor kind of sentiment was basically a big meh, right? I mean, at this point, unless the investor is getting some sort of credit for investing in this, you know, what they really care about is yield and performance of their portfolio, right? I don't know. Am I wrong, Manus, there?
Well, we'll get into a little bit of inside baseball, but you know, money managers have a scorecard, and that scorecard is returns, and those returns are measured against other people with the same strategy or profile, right? Usually, the Barclays Index was the big thing for fixed income. You know, 15 years ago, 20 years ago, the big thing was adding more CMBS to your portfolio because that carried higher spreads, and that would give you higher returns, and those higher returns would allow you to beat the index. Some people would get even friskier and invest in interest-only bonds because they gave you a little bit more spread, and that's the way it worked. And you know, one thing that would certainly get people's attention is, if all things being equal, you got an extra 5 or 10 basis points for being in a green deal. But right now, it doesn't seem to be the case. It seems like you're probably getting the same kind of return, or something maybe even a little bit tighter. So the financial incentive is not there. And so unless your boss says to you, you know, your compensation is no longer based on the Barclays Index or whatever that's called now, you know, it's with the Lehman Index also, it's now based on some kind of ESG index. You know, I'm not sure that they get any more attention than any other SASB deal at the moment. But to be honest, I didn't see how that deal priced or the talk on it. So I don't know if it was wider or tighter, but to me, the metric is total return.
Well, I think that the story, not about this one, but I think in general that we hear, is that you are, and this may just be a story, it may not be the reality. The capital markets are trying to incentivize certain behaviors by giving lower financing costs to those people that are exhibiting those behaviors. And where the virtuous circle, or maybe not, the virtuous circle comes in, is that the pool of capital on the side coming from the likes of BlackRock and TD and Teachers and all these other places have ESG mandates, or they have maybe not mandates, but you know, missions and things like that, where
Dedicated funds,
right, where they're pushing money into these places, which then makes the yield lower, which makes the cost of financing lower for these types of borrowers. But it only makes sense if those funds are doing that. And I don't know how long, like, listen, every millennial in the world could want to save the earth, but when they look at their 401k, they're going to really care about whether they can pay for their retirement, or whether they can pay for their kids' colleges, or what, you know, when rubber meets the road, they're going to want returns. And the other stuff, I think, takes a back seat. So I don't know how long this can sustain itself. Do you know what I mean?
Well, I'll amend what I said before. I'll amend it in this way. I said before that these guys are incentivized by beating the index, and that's not really true anymore. If you're in a fund that claims to have a social mandate, right, and you're telling your investors in that fund that we're meeting criteria X, Y, and Z, then perhaps that is your only mandate, right? And that completes the virtuous cycle that you're talking about, that tighter pricing, access to capital, right, incentivizing borrowers to retrofit or build in this capacity, and then it meets the goal of the program or the ideal.
I guess it's going to have to be the ratings agencies probably that come out and actually put out a list and say, this is exactly what E means. This is exactly what S means. This is exactly what G means.
As we started off the podcast, time will tell. We're just speculating.
Speaking of the start of the podcast, we started talking about the CDC announcing that the moratorium is extended to July 31st. Some people had thought it would actually be extended to the end of September, when jobless benefits were set to expire. And as you know, many of the landlords are having trouble accessing the systems and the money that's been set aside for rent relief. So how's that going to play out?
Well, they're just going to extend it again. If I'm being really cynical about it, I think that's what's going to happen. We've said on this podcast before, it doesn't really make sense that the CDC is saying anything about evictions. We've heard stories, on panels and other kind of industry folks talking about paying people to get out as opposed to trying to evict. So that's, still happening. I do think, in general, the collection percentages in multifamily are still reasonably high. I think RS at Commercial Real Estate Direct had written something about it this past week about how multifamily collections have come down a little bit, but they're still kind of high compared to all other property types. So, I'm sure there are lots and lots of stories of landlords who are kind of getting the shaft, as it were, right now. But in general, multifamily is performing pretty well, thanks to all these unemployment benefits and just people working from home and making money and not spending as much, right? Being able to pay that rent.
I mean, the single biggest thing that, I think would work towards getting the economy open and reestablishing, a sane system and it's really across the board. I said earlier, as a taxpayer, having some skepticism about the government covering the whole student loan market or the whole, mortgage market, the residential mortgage market. And when it comes to other things like we're talking about now, eviction moratorium, the real thing that's been missing throughout all of this is the means test, right? Whether it's eviction moratorium or perhaps forgiving student loans or other types of things, right? We've been using very blunt instruments to kind of quote unquote get the economy and get people over the hump. But a lot of people didn't need that jet propulsion of stimmy checks and other things. They were still working and so forth. So, if there's one thing I'd love to see Democrats and Republicans come together on, it would be kind of tailoring any kind of program like this in the future to something that really hones in on those that are hardest hit by these things, as opposed to just throwing water balloons everywhere.
So turning to retail, we have a wave of a bunch of different types of news, valuation.
People have talked about this for a long time, that 2021, 22, 23 would be kind of the day of reckoning for shopping mall loans and retail loans in general. It was such a big period, those 3 years, 2011, 12, and 13, for financing in the CMBS market for these properties. And now they're all coming to their maturity dates now. And so we have a whole host of headlines we've written about in our research this week. I'll run through kind of the good, the bad, and the ugly. Let's start with the good. There was a $127 million Deerbrook Mall. That's a property in Humble, Texas. The loan missed its balloon date in April. It was resolved this month with a loss of less than 10 basis points. So basically, the borrower found refinancing. There was a small amount of fees that came out of the principal retirement, $118,000. And this was a loan that appeared to be headed for receivership. Special servicer comments in May indicated as such. The maturity date was missed. And here we go with a loan that was actually paid off virtually in full. So for those that are wringing their hands nightly about shopping mall debt, that was a positive story that came out of the week. Another story of positive note for CMBX 6 longs, the Bricktown Square property. It's in Chicago on Fullerton Avenue, a nearly 300,000 square foot retail center. It was acquired by Newmark Merrill-Co's. That story comes from Shopping Center Business. That property backed a $30 million loan, which was part of CMBX 6. The interesting thing about this one is that for 2020, the DSCR was only 1.02x. So this wasn't the kind of thing where, well, this is a no-brainer. This guy's going to get taken out. You know, it is grocery anchored, but it certainly wasn't something with a 1.50x DSCR where you thought it was, you know, a no-brainer. So this one being paid off, another positive sign for the market. Then we got a couple of negative stories. Joe before mentioned Commercial Real Estate Direct. They did some great reporting this week. They're a sister company of ours, by the way, as a matter of full disclosure. They wrote a piece last week that said that Washington Prime had set aside several more malls as non-core. So they reclassified them from tier 1 to non-core. Usually when a REIT does that, it's kind of a way station for a loan becoming an REO situation. Kind of a deed in lieu is kind of on the way. So in this particular news, there were 5 big loans that were impacted by this. The Cottonwood Mall, that's in Albuquerque, New Mexico, $92 million loan, makes up 10% of a 2014 CMBX deal. The Dayton Mall in Dayton, Ohio, was another. Brunswick Square, $67 million loan. That's in East Brunswick, New Jersey. That backs a couple of 2014 deals. The Lincolnwood Town Center makes up 8.1% of a CMBX 8 deal. That's in Lincolnwood, Illinois. And the Port Charlotte Town Center, that backs a 2011 deal. That's in Port Charlotte, Florida. So those are 5 malls in the CMBS realm. There's others beyond that Washington Prime said no longer are a focus for them.
Yeah, we had one more story. It's not Washington Prime, but it's similar. Beleaguered retail REIT CBL. It was a $59.9 million Jefferson Mall loan. The value of that property was cut from 101.7 million as of securitization down to 34.7 million, according to servicer data this month. That deal's in a 2012 CMBX 6 JP Morgan deal. It's a 280,000 square feet of retail space in Louisville, Kentucky. Just, you know, look at this murderer's row of non-collateral tenants here. Dillard's, JCPenney, Macy's, Sears, and Toys R Us. If you just put all those together into any mall, you know, you're probably looking at some trouble.
Right. The Macy's and Sears have closed, even though those still operate stores. Toys R Us obviously liquidated in full. So of those 5, only Dillard's and JCPenney are left. That loan that you're referring to makes up almost 10% of this JP Morgan deal. That's part of CMBX 6. And interestingly, there's a second loan in that deal, the South Park Mall loan, which also, it's another CBL property, also had its collateral downgraded or lowered from $103 million valuation to just $40 million. So between these 2 loans in this one JP Morgan deal, more than 18% of the collateral saw the value of the collateral cut to well below the loan balance. So if you're somebody who owns this deal and you're owning like the AA or the single A bonds, you now have to go back to your slide rule and figure out, you know, how much credit protection do I have at this point? Or if you don't have a slide rule, of course, you could always just subscribe to Trepp and look at our calculation for appraisal adjusted credit enhancement. Much easier than using that old-fashioned technology.
I thought you were going to go with the abacus.
Yes. You know, the last trend we saw this month is a whole host of loans between 5 and 10, all of size, more than 50 million, that have now entered the, let's call it the CMBS Mall Loan Witness Protection Program, right? They're neither fish nor fowl, kind of cluttering up metaphor after metaphor, but they reached the maturity date, did not pay off, are now in CMBS purgatory without any clear direction as to whether there's a foreclosure coming, a modification, or a payoff. So, we could rattle off 5 or 10 names right now that just hit the wire this month that are now just sitting out there waiting to be resolved and may still be out there a year from now.
In office news, the big investment banks are asking their return to work employees to come back if they're vaccinated.
So Morgan Stanley, I think, said everybody has to be vaccinated to come back to the office. Or let me be epically clear, everyone has to attest to being vaccinated. So I don't really know what it means if you attest, but you are not. Is that some sort of like legal document or something? I'm not sure. You did see Jamie Dimon, or maybe it was some internal memo. I saw a Post article about it today, that JP Morgan was not going to require workers to get vaccinated, but that they still will expect them back in the office, and they'll just have to abide by different rules, masks and testing and that type of stuff. So not surprising that the banks are leading the way here. It's known that there's a culture of working hard in the office, long hours, cutting your teeth, that type of thing. So it's not too surprising. But I think that we keep hearing these headlines, we keep seeing these headlines, but there has been no significant uptick in terms of overall number of people going back to the office. I should say in like New York, Chicago, San Francisco.
Well, it will be interesting. The wording is everything, right? I could have attested 3 years ago that I had a vaccination, right? Long before anybody had ever heard of COVID. So if it's just any vaccination, yes, that's easy for everybody to declare, right?
You're good on
rubella, right?
You're good. Mumps, you're good. I think we have some stories about office buildings.
We should take a quick diversion that both Joe and I are on vacation this week. So we're doing this from the remotest of remote places. So if we sound like both punchy and or modestly unprepared, that would be your explanation for this. In Joe's case, he's had several days with kids under the age of 4 or under the age of 3, I guess. And on my side, I've gotten endless texts from Joe about that process.
So if you are a loyal listener, and I'm sure most of you are, I'm sure you've been eagerly awaiting the update on how the trip went. And I will say, first of all, from an economic standpoint, LaGuardia was pumping. It was packed. The check bag line was to the door. The security line was as long as I've seen it ever. So, and this was Monday morning that we were flying. So there's that, right? So the whole thing about TSA pass-throughs and everything else, there's a lot of people flying, a lot of people moving. I'd say the vibe was relatively relaxed. Nobody was really freaking out too much. Everyone was kind of going about their business. But I will say this, getting from the sidewalk to the gate with bags, carry-on bags, checked bags, a stroller, a 6-month-old, and a 2.5-year-old who's very strong, it should be an Olympic event, I have to say. And then you put a mask on. So you're only at like 52% oxygen. You got fear that you're going to lose a kid. You got fear that you're going to miss the plane. And then you got this mask on. I felt like, you ever see those NFL players when they're training in the off season, when they have the weight vests on and they're on the treadmill, and then they have the mask on that only gives them a certain amount of oxygen to really get their blood flowing? That was me when I made it to gate number C30 or whatever the heck it was.
I was wondering where you were going to hone in from today or I should say zoom in from today. I thought, I told the audience last week, I thought you were going to get, bound and removed from the plane over some incident, and you'd be recording from Folsom Prison or something like that. So
So we have office news.
Yeah, it's finally back to the commercial real estate stuff. I took a little oxygen there. So let's give you a couple of things in each category. The must know, the good, and the bad. So the must know this week, this comes from Commercial Observer. Citadel, the headline is Citadel is back on the hunt for Miami office space. If you go to Commercial Observer, you'll find that particular story. They're looking for about 85,000 square feet. The article notes that Citadel had shortlisted a property on Brickell Avenue, but is now expanding its sites. So if you have, if you're a broker in Miami with about 85,000 square feet of space, it's time to get on it, I have to say. A couple of other must-knows for the week. Travel tech company Amadeus, they themselves are looking to downsize in Miami. They're putting 85,000 square feet on the market. So if you want to double dip, if you're a Miami guy that knows both travel tech and Citadel, maybe you could put one and one together and make it work for both firms. And then lastly, a headline that came out today. This is from the Biz Journals. IBM is putting up for sublease more than 600,000 square feet in the Research Triangle area. So a big swath of space in that Raleigh-Durham market going to be coming on the market pretty soon. A couple of real nice green shoots this week. This one from the Real Deal. The Atlantic Health System re-upped for more than 500,000 square feet in Morris County in New Jersey. So that's great. You rarely see leases of that size. So that's a terrific renewal in central New Jersey. According to the Dallas Morning News, the FDIC will be moving its Dallas headquarters. So the winner there, the owners of the Plaza of the Americas, which is at 60 North Pearl Street, they get the FDIC as a new tenant, more than 160,000 square feet. The loser will be the owner of a building on Bryant Street in that town. And lastly, law firm Womble, Bond Dickinson, they renewed its lease at 1 West 4th Street in Winston-Salem, I believe. That was a property that we highlighted a couple of years ago in our Trepp Wire. The big story there is the loan at one time lost, I think, about half its value because they had lost Bank of America or Wells Fargo as a tenant, but they got a re-up at that particular property. Good on them. So they have about 30% of the square footage, 130,000 square feet in a property that was built in 2002 in Winston-Salem.
So yeah, we had a couple of other crabgrasses, I would say, or crab's grass. Maybe it is. It's like passersby. One is a Denver office loan and one is in Jersey. So in Denver, we had actually pointed out, I think a month or two ago, to keep your eye on the $104 million World Trade Center 1 and 2 loan. A couple of the tenants there were in the energy business, and there was some rumblings. It's 800,000 square foot office complex in Denver, Colorado. In July, Schlumberger announced, is that how you say it? Schlumberger announced it was considering layoffs for 21,000 employees. That's the second largest tenant with about 11% of the space with a lease till 2026. A couple weeks later, Noble Energy, also a tenant, filed for Chapter 11 bankruptcy. Noble is the top tenant at the property at 16% of space with a lease ending December of last year. So, a modification on this loan previously had allowed the borrower to use excess cash flow reserves to pay debt service. Kind of sounds like it's not FF&E in hotels, but kind of similar story, using reserves to pay the debt service. It was that modification was going to end this month, and the special servicer notes this month say that the loan is expected to default at the end of that accommodation. So the borrower has been marketing the collateral for sale, but has got no offer yet. It was valued at $176 million in 2013, and it makes up about 11% of the collateral behind a 2013 JP Morgan deal. DSCR has been under 1 for the last 2 years or so. So that's kind of a big one in Denver, a pretty hot market. with a kind of a crabgrass office story there. And then in Jersey, similar story, different industry. We had talked a couple of years ago about looking out for exposure to opioid pharmaceutical companies. And one of them was Mallinckrodt. So back a couple of years ago, their stock had dropped big time. Had hired restructuring advisors. It was facing bankruptcy based on some of these lawsuits, right? And back then, we noted that this company, Mallinckrodt, was the dominant tenant behind a $42 million office loan, the Somerset Financial Center. It's a 230,000 square foot office in Bedminster, New Jersey. And Mallinckrodt is the 83% of space. This month, the value of this property was cut by almost 75%. It's split, the loan is split across two deals, 3.5% of a Wells Fargo 2018 deal and about 2.3% of a UBS 2018 deal. It had been valued at 65 million in 2018. Now it's valued at 17. So it just goes to show you that some of these office buildings are kind of a feast or famine situation. And, you know, we talked to Don Sheets about some of this stuff a while back, but there is a play for if somebody can come in, take over the collateral and get that thing leased back up, you know, you could, the value is cut by 75%. You could probably increase the value by 100% after a couple of years if you know, can get some good tenants in there.
You know, we know that a lot of listeners get Trepp Wire from us, but there are several, you know, probably a good percentage do not. And, you know, when we talk about our research, what we're really trying to do for our clients and our readers is to point out these potential landmines, you know, a year or two before they explode. So, you know, in the case of that Denver office space, what we really tried to highlight last summer was the exposure to energy tenants that were on the ropes. And now we find out, you know, almost a year later that this thing is, you know, I wouldn't call it dead loan walking, but it's certainly a loan of concern at this point. And the same thing was true with this opioid lawsuit, that, you know, so much of what we try to do is help our clients and our listeners on the podcast and so forth know their potential liabilities, help them with risk management in an area that can be fairly opaque at times.
And Manus, you have a quick hit in the hotel sector that's an interesting story.
Yeah, we got the trio of mentions from Commercial Real Estate Direct. I like this one. I don't have a lot of hotel stuff this week other than to say that we're seeing, you know, continued improvement in that sector in terms of continuing resolutions of assets, either curing or paying off or so forth. But Orest Manzi wrote a story. He's their editor-in-chief this week, that Hyatt Hotels Corp paid $148 million for the 59-room Ventana Big Sur property in Big Sur, California. The interesting thing for this was that Hyatt was paying more than $2.5 million per room, and the article says that this is an all-time record for price paid per room in North America. So just both a sign of the recovery, a sign of faith that the recovery is not transitory, as people talk about with inflation, and that people believe that this bounce back when it comes to at least leisure travel is real and enduring, right? A great sign to be paying a record price for a property this close to the end of a pandemic, where not all of the benefits of coming out of the pandemic have been realized yet, right? There's still a little bit of leap of faith here that this is going to all work out.
And today, the Fed released its stress test results for large banks after the closing bell. All 23 lenders passed well above the minimum required capital levels. But what were the big takeaways, and how does it match up to our own analysis?
Well, the takeaway was boring. You got to fail somebody, don't you? I mean, like, come on. What's the point of stress testing if you don't just, you know, fail somebody? You got to fail somebody once a year, you know? It just came out right before we were recording. So the headline is that everybody passed. So no big bank stocks are, you know, cratering like they do when they don't pass. We did put something out on our blog and as a research piece comparing kind of the results of the stress tests from the banks versus the results of the same stress tests through some of our models. And, moral of the story is that, our models were kind of spot on, which is a good thing to hear. And a little bit more commercial real estate related, we updated our bank loan consortium kind of stress test run, where we run all of the banks that contribute to our commercial real estate consortium. It's about 150 or 160 billion in commercial real estate loans outstanding. We run all of those loans through our default model through the couple of Federal Reserve scenarios. And just some headline numbers here. You guys got to go read the piece to kind of get some more nitty gritty. The headline numbers are in the baseline across all property types, across all vintages, about 30 basis points in 5-year expected loss, 6.3% in the severely adverse case, which is a very, very severe case. And in the quote unquote COVID case, we're at about 2.6%. Now, lodging is higher, retail is higher, office is slightly lower, industrial is much lower, multifamily is kind of right on par with the total average. So not a ton of indicators kind of in my mind here, but good stuff to be kind of keeping aware of.
For those that are not fully attuned to what a stress test is, in short, the regulators give you a set of variables that talk to things like GDP, unemployment, interest rates, commercial real estate values, things like that. And, there's a baseline, there's an adverse, a severely adverse. And the severely adverse are things like, double-digit unemployment rates, severely negative GDP, low interest rates so that, bank margins, right, their income kind of falls considerably, right? The plunging commercial real estate values will trigger a higher level of defaults of their loans. And in short, what you do is you take all of these inputs, you run it through your loans, what kind of losses you have, how that will impact your interest collections, et cetera, how that will impact your write-offs. And at the end of the day, what you're looking for is what the bank reserves, balance sheets, income, et cetera, looks like under all three scenarios. And while Joe says this one is boring, that is true. There isn't a lot to report here. But 12 years ago, before banks built up their capital bases, and when their capital bases were skinny, there were banks that would fail. You'd run through this entire soup of things, and certain banks would see their capital ratios really decline to levels that were really unsustainable, right? And we've used the last decade or so managing this process and urging banks and regulating banks to rebuild those. So, I would say boring is predictable, but also a function of, banks taking their medicine and doing things that put them in a much better financial position now. But it's an interesting endeavor. It was very fun when we built these models, and it's always great to see how we compare with the regulators.
And look, we just went through a scenario that was significantly worse than a severely adverse case, right, in COVID. And thanks to the capital that was already there, the banks weathered it just fine. So as much as I, think a lot of this stuff is additional red tape and a lot of extra work for a lot of people, I think, the spirit of it was right. And the spirit of it helped make sure that we didn't, completely crash a year ago.
I mean, the bottom line is we've seen very, very few bank failures over the last 5 years, right? In that window from, 07 to 2012, give or take, I think we saw about 350 at that time. And that was, banks that had bad loans and, just marginal capital to protect themselves. And it was sizable.
Turning to shout-outs, we have Oz, who is also known as Matt O. He had a couple of questions for us that we'll have to put you guys to work on when you're back in the office. Questions about risk retention types and liquidity availability for the office market. So we will put something together more substantial and get back to him on that. BB at Dogged Tenacity responded to our comments about Office, about putting your finger in the air on Office. I think, Joe, that was your comment. I think he commented on that with a little GIF from Schitt's Creek. So I thought that was rather amusing. Scott Berry shared our analysis cited in Wealth Management about CMBS maturity data. Andrew Gent of Keenan Flagler responded to Manus's Treppwire NCAA plug this week. Loved that. And they know a NCAA D1 golf coach, and they'll let you and Joe know. So hopefully you guys are working on your golf game because you might have a shot.
I would be a perfect guy to, maybe clean the clubs, drive the cart back to the shed,
smack the cleats together at the end of the round.
Yeah, I don't bring a lot to the golf course.
I will say, a quick diversion. I used to work at Pelham Split Rock Golf Course behind the counter when I was in college. If anyone plays there, give us a shout at podcast@trepp.com. Maybe you remember me cursing you out when you came in like 20 minutes after your tee time. But the Fordham golf team used to practice there. And the Fordham is not like known to have like an amazing golf team or any athletic really thing anyway. And I could say this because I went there. But the golf team used to come in and practice, and their coach was Paul Dillon, the father of Matt Dillon and Kevin Dillon, the actors. And he would come in, and one time he came in and we were checking him in, and I asked him, I said, hey, I go to Fordham, what's it take to get on the team? And he asked me what my handicap was. And I think at that time, I don't know what it was, 8 or something. I was like, it was like an 8 or something. He said, yeah, no chance. I was like, oh, thanks, man. Like, I was just hoping he'd be like you, right, Manus? Like, yeah, come carry the water and maybe you can hit a few balls or something. But there was just no chance. There's just a different level of play.
Yeah, I mean, my general experience is I get to the par 5 17th needing a 2 to break 90. Right, and that's the 17th, not the 18th. So that kind of.
I hope the people who have invited us to their very fancy golf courses aren't listening right now.
Yeah, well, they've tuned out.
I'm just there for comic relief.
Well, next week is, of course, the July 4th holiday. And with the reopening of the country, many of the fireworks and festivities will be back as expected. And even though many people will be on vacation, our podcast team is going to go back to the tape and listen to how Manus and Joe fared with their 2021 predictions. And then we will grade you on how accurate you are with this month's delinquency numbers. And there will be no curve.
Well, you'll notice that I haven't given a sports prediction in about 4 months. And I think I'm going to keep that going because I think that I've given 3 over the course of our 85 or 90 episodes, and all were epically terrible. So I'm eager to redeem myself slightly next week, although I have to say I haven't looked at the numbers yet, and I'm hoping that redemption is the word I can use next week and not humiliation.
I just have to point out that it doesn't really matter if we're right or wrong. What matters is that we are the only economic, finance, podcast, TV show, any sort of media that goes back and checks their work, right? So it's a little intellectual honesty for the Treppwire listeners on the July 4th weekend.
Exactly.
There we go. And after that, we'll put on the top 500 songs of all time and go on a vacation for 2 weeks, right? Like they do at the radio stations.
Play the tape. With that, we'll close. And thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Come back from vacation, guys. Thank you for listening and stay well.
All right.